Very good morning to all of you. So we are back with another session of PGBP itself, right? So we had discussed certain things in the last class, right? Like some tips, some suggestion from my side saying that some of you, like all of you, have to revise at least 15 minutes to just recap your old session. So that refreshing or revising for just 15 minutes of the same class, we said that it will be helpful to remember things on a longer run. So beyond your examinations, or more importantly for examination, it helps you in remembering. So I wish that some of you at least have actually tried that exercise, started that practice, started that habit of refreshing it for at least 15 minutes. So the 2.5 hour session, just give a thought for 15 minutes on what was discussed and what is something important as far as you are concerned. So this itself will give you the confidence of feeling that you know these two words that you remember, that you know, will definitely help you in scoring good in your examination. It's not even about 40, it is something about, let's say you need to score more than 60. So for that confidence, for that belief, I think this will help you actually to help you know that you know provisions, that you remember provisions. So this will definitely help you. I definitely believe that some of you would have tried. If someone of you would have tried this exercise, please let me also, so that I feel happy. So that's the thing. For those who have not tried, I suggest that you keep trying it. So you start this habit of revising it 15 minutes. And we also said in the last slide that there are 3 problems related to things that we discussed. And I had asked you to solve it, though it is from study material. I wanted you to solve it on your own and to see how much you have understood the provision as it is. So that's what it is about. So I wish that some of you have tried that also, the 3 problems that we are talking about, 6, 7, and 8, illustration in your study material. Okay. So with this, if you wanted to just recap and think about what we discussed in the last class. Okay, so as I told you, it will just be a refresher. I'm getting some responses that Dhyanesh has tried that refreshing of 15 minutes. I'm very happy, Dhyanesh. I'm sure it will be helpful of you doing it for all your subjects, across your entire curriculum. If you keep this as habit, it will definitely help you better. Okay, so if anyone also have tried this 15 minutes refreshing, you may let me know. Okay. So we said that it is very helpful. And yeah, Arshid says that he has tried it, but it took him 30 minutes. Yes, of course. See, when you try to compare with study material and slide, study material is like the act itself, right? So it is in very detailed form. It's a raw form of law or something with some explanations on their own. But when it comes to slide, we are trying to put it in a simple manner. Where we are trying to crystallize the entire portions in a short single slide. Let's say if section 35 is discussed in 4 pages in your study material, we are trying to put it as one single slide. So this matters a lot. So what I wanted you to do is probably look at what we discussed and look at the slide. See if you are able to correlate, see if you are able to understand the concept of the provision, the crux of the provision. Study material is detailed. Once you understand the concept and then you go into the study material, you'll get a different picture. When you read the study material first, it might look Greek and Latin, but after seeing the slides that I'm providing you, with the explanations that I'm providing you, then if you're looking at the study material, it will give you a different picture. It look like the regional language or the mother tongue that you know. It look like very familiar to you. It will not be very Greek and Latin. So this is my suggestion. So leave out study material, go through the slides that are provided here, just refresh, just recap on whatever was discussed during this 2.5 hours. Then it will help you. Then go into the study material, you will understand study material better. So definitely, I'm sure most of you will try in this process. Like we have just said, the process in which this refreshing has to be done. And yeah, good. Anand has also tried. Very good, Anand. So Alok Shivlani, yeah, I'm happy that you tried today. So please make this habit. So we'll get into this. Okay. So we had three problems. Before getting into the three problem, as I told you, we'll slightly refresh. Okay. When we say refreshing, we'll talk about what all we discussed. We discussed about section 43.1, which is nothing about cost, right? Cost of the asset. So how do you derive the cost? We saw exceptions like when it is given by gift will, or when a building is previously owned by someone, or let's say when the inventory is converted into capital asset. What do you do to interest, capitalized interest? What about subsidy grant? What about reimbursements? All this, right? So this is what we discussed in 43.1, and then we discussed about 43.6. Okay, it was about what? WDV. Okay, so we discussed about how do you arrive at WDV. So what is it? When will WDV nil? When will it be nil? What do you do to addition of assets? So if it's a new asset purchased during there, the WDV is nothing but the cost of the asset. So we discussed about WDV, right? And then we discussed about section 35, that is scientific research. We said there are three category of expenditures that you can claim. One is for own business versus C. Another is paying to another company, institution, association, or organization. The third one is in-house research and development for certain businesses, that is biotechnology, or in the concept of what you call manufacturing other than the products provided in the 11th schedule. So these are the items that we discussed. We said 100% of revenue and capital expenditure can be claimed as the thing. And there are some exclusions, right? Like, right, if it's own business, land is not allowed. If it is in-house research, it is land and building. We also said why. I think Kavita requested about why land should not be included. We discussed about how it could be misused also. So land, building, how these things could be misused. So we discussed those things also. So this scientific research is the next thing that we discussed, where we said it is 100%. We also discussed about the carry forward, right? Carry forward losses, on how it will be treated, what if the asset is subsequently transferred. All that was discussed in section 35, right? And then we discussed about section 35 AD. That is for, we'll just call it a specified business. So specified business, we said from cold chain facility to hotels, to hospitals, and to infrastructure facility. So there are so many business that were listed. Close to 12 businesses or 13 businesses, if I'm right. So those businesses, if someone is running that business, from the year of commencement, they're eligible for 100% of capital expenditure of whatever they've incurred, excluding three: land, goodwill, and financial instruments. There also we said why goodwill should not be included and all. We discussed that also. So typically, this is what we discussed in the last class, these sections. So 43.1, 43.6, 35 and 35 AD. Now we discussed about some of the problems in this particular thing. So one was this illustration 6. So where we are trying to say Mr. A has commenced business setting up a warehousing facility of storage of food grain, okay, sugar and edible oil. So he is doing sugar and edible oil. So there are three expenditure. Then he has set it up on 1st April 2022. He has incurred an 80 lakhs, 60 lakhs, and 50 lakhs respectively for three business. And during that period, Jan and March, he has also, that he incurred capital expenditure of 80, 60, 50 respectively on purchase of land and building during the January 22. So he has purchased both land and building in infrastructure. So what is not allowed? Land is not allowed, goodwill is not allowed, financial instrument is not allowed. So now what is not allowed is this particular land. So they say it includes land and building. So for the above business, and capitalize the same on 1st April 22. So this is something like prior period. So he has incurred before incorporation, that is before April 22, but he has capitalized only on 1st April 22. What is relevant is, what did we say? Some words are to give you information, some words in the question are to confuse you. The problem will have some words which will help you solve the problem, or some words will just confuse you. So you must differentiate between a word that helps you, that confuses you. This April 22 capitalized, that is capitalized on the books of accounts on 1st April 2022. Is it confusing or is it relevant? If you ask me, it is relevant. Why? Because the provision says if it is incurred before 3 years, that is, it is incurred before incorporation, before commencement, it is allowed as a deduction provided it is capitalized. Provided it is capitalized on the date of commencement. So when was the commencement? 1st April 22. When was it capitalized? 1st April 2022. So which means it is eligible. Otherwise, it is generally not eligible. So cost of the land is incurred. They've given you the cost 50, 40, and 30 of the three business. And during the 2023, he has incurred 20 lakh, 15 lakhs, and 10 lakhs respectively for extension, reconstruction of the building purchased and used exclusively for the above business. So he has also invested for extending his business. So when we said infrastructure facility, we said all capital expenditure. So if it is a capital expenditure, it is allowed. So now they wanted us to compute the profit and gain. So what do you do now? So as far as this profit and gains are concerned, typically we need to know that this three business, food, sugar, and grain. So we need to know whether these are eligible, right? So we first need to understand the eligible business. That's the first exercise. Because we know the question is about 35AD. 35AD talks about specific businesses. So in that, we need to see what type of business is allowed, not allowed. If you actually look at it, food grains is allowed, sugar is allowed. Please remember it this manner, some form of agriculture, okay? Some form of agriculture, that business is allowed. So food grain and sugar is in a way kind of agricultural activity. Sugar is derived from sugar cane, right? So sugar cane is an agriculture activity. So please remember, these food grains and sugar from sugar cane is an agriculture activity, hence eligible. So remember it that way. Edible oil is completely for the, what you call, home use, for the consumer's use, which is not a specified business under 35AD. So these businesses, that is food grain and sugar, is eligible. Sugar, the edible oil is not eligible. So what is the profit from eligible? They have also given us a profit, saying that the profit from the warehouse facility of food grain, sugar, and edible oil before claiming deduction under 35AD and 32. So both depreciation and 35AD has not been provided. So if you actually look at these two sections, if 35AD is provided, no other provision could be provided. If 35AD is provided, no other provisions under any other section can be claimed, which means 32 cannot be claimed. So for 23-24 assessment year, they've got 16, 14, and 31 lakhs, correct? So we'll first compute for edible oil. So as far as this edible oil is concerned, we'll have to first write this as what? Computation of profit and gains of business or business and profession, let's say of Mr. What is his name? Mr. A. Mr. A for assessment year 2023-24, correct? So these are the two businesses. Just give me a minute. Okay. So profit for assessment year 23-24. So in that, we'll actually write, we'll just put it across this manner. Particulars. Okay. We'll have it as an amount column. Amount column and probably a reference column, that is notes. Okay. So what are we going to do here is, so we first compute the total. So what they want us to do is calculate the total capital gain, right? So what we do is we try to understand for these three businesses. Okay. So what we actually do is they want us to know actually compute also compute the income, okay? Compute the income under PGBP. So we need to compute the income. So how am I going to compute? I'm going to compute the income first. So we know there are three businesses. So let's say profits from storage of edible oil. We'll work this in working one. And then it is storage of what? Food grains, right? Food grains and sugar both come under your, what you call it. It comes under your same business, 3580. So we'll compute this as one node, one single node. That will be work node. So which will be what? So you will finally arrive at the profits and gains from business and profession, correct? So we'll find out this. So this is how typically we identify whatever is relevant. So now we need to work out for working nodes. So we'll call it as nodes. So the first node will be profits from what? Storage of edible oil. So we need to compute from storage of edible oil. Then we calculate the value. So that is particulars amount. Again, if you require a reference, you have to write reference to provide notes. As I told you, notes are very, how many ever you can fill in, it is critical, okay? Because that is the thing that helps you convey to the valuer that you know the provision, that you have not solved it just by guess or something. You have understood the provision. You have interpreted the provision. Please understand, it is very dash critical. So this will help you actually convey to the valuer that you know the provision. So it is very important. So almost wherever possible, even if you think it is so silly, so straightforward, still write it. Still write the note. It doesn't make a difference. It is more better, right? Because when you know something, it's always better to also write it in number, in like a theory, saying that this is why I have considered this as an addition or deletion. Okay, now particulars amount. So if that is required, you must have a column for that. So now let's say we have to take the profits. So profits of edible oil is 31 lakhs, correct? So I go and add 31. Okay, now this business is not eligible. This business is not eligible, which means they are eligible for what? Depreciation. So 3580 and 32. So the question itself talks about two sections, 3580 and 32, correct? So 3580 and 32. So it is very important that you go through that. So now, as far as this 32 is concerned, we'll have to provide depreciation. So less depreciation. Just that we need to see whether book has already provided any depreciation. So it only says that before claiming deduction under 3580 and 32, which means everything is adjusted, just that we need to provide depreciation and 3580. Otherwise, what should you do? You should first add the book depreciation and then reduce the income tax depreciation. So less depreciation. So what is the total cost of the asset of the businesses? That is, edible oil is 50 lakhs. And then the cost of the land is 30 lakhs, correct? 50 minus 30 is what? Because land is not depreciable. So 50 minus 30. And then again, they have spent another 10 lakhs. So which means total cost, that is, we'll put it as 50 minus 30 plus 10. We'll assume everything is calculated at 10% because the question has given that we have to take it as a building, because it only says land and building. And then other expenses also extension and reconstruction of building. So when you say building, it is residential, non-residential. Residential is 5%, non-residential is 10%. Of course, we are talking about a business called your factory business or whatever it is. So it is 10%. So this into 10%, which will be what? 3, right? It is 20 plus 10, 30. 30 into 10% is 3. So this edible oil business is how much? 28. So I go and fill up this 28 here. Okay. Next, I'll have to compute for 2. What is that? Profits from food grains and sugar. Correct? Food grains and sugar. So now, as far as this is concerned, again, I'll have to compute. I'll have to compute as particulars. If required, I'll have to have a reference column and then an amount column. Correct? Okay. So now, also, sorry, I'll have to have it as 2 business, right? So we'll keep it as sugar, food grain. So we'll have it as 2 business. So first we'll have to write the profits, whatever is the profits earned. So what is the profits earned? It is 16 and 14. So I take this number 16 and 14. Okay. What did we need to do? We need to find out the deduction under section 35 AD. So we'll say less deduction under section 35 AD. So first was it was let's say capitalized on 1st April 22. That is, it was prior to commencement, right? So, but it is capitalized on 1st April 2022. So that asset was how much? 80, 60, and 50. So that is 80 and 60. But in that, land value is 50 and 40. Correct? So it is 80, 60 minus 50, 40. So that is 80 minus 50, right? 80 minus 50 is 30. And this is 20. Correct? So this will be 30 and 20. Because this 30 is typically, which is nothing but 80 minus 50. You can always put that as another note or a reference also after excluding. So we can say, or we can write it here as excluding land. So now the valuer know that land must be excluded. This conveys to him that you know the provision. This definitely helps you in all problem papers, in income tax at least, in law papers at least. So please make sure you write notes as much as possible, however silly it is, however straightforward it is, write a note. So we are excluding land, and then there was an additional asset, right? So during the year, so let's say capitalized during the year. So typically, how much it is? It is 20 and 15. 20 and 15. So if you actually less it, profit or let's say loss. So it's typically 16 minus 50, right? 16 minus 50 is your thing. So the loss will be 34. And here the loss will be, that is 35. 14 minus 35, it will be what? 21, right? Okay. Now I write nil here and take 28. Why? Because loss from specified business cannot be adjusted with profits from non-specified business. So I write a note. So we'll say that loss of food grains, or we'll put it this way, loss of 34 lakhs and 21 lakhs from food grain and sugar business respectively will be carried forward as loss from specified business. Correct? Loss from specified business cannot be adjusted with profits from normal business. Okay. So I've written in it my own handwriting. I told my handwriting is very, very poor. But the point here is just to convey you what you should do during the examination. So you must write notes. So that's the point repeatedly I'm trying to make. So notes are very, very, very critical for the examination. So whatever is there. So please say that this loss, that is 34 and 21 lakhs or 55 lakhs, cannot be set off in the current business because it can only be set off with another specified business. So which means it is being carried forward. So that is the only thing. So we have to write about, anyways, we'll see the loss details when we are seeing that chapter, set off and carry forward loss. So you will know how many years and all. The point here is for this particular section, you need to know that it cannot be adjusted with normal businesses. So that's the only thing. So that's how you need to fill it across. So that's what it is about. So we'll move on to, I will not discuss the other two illustrations that we spoke about in the last section. So you of course can work out. So I will not discuss about it. So rather we'll move on to the today's session. So these are the things that say. So if some of you have worked out 7 and 8 also. If there is any queries or something, you can definitely let me know. Arshit, yeah. So Arshit is actually trying the slide first. He's trying to understand it and then going into the study material. Very good, Arshit. So you can always proceed that. 43.1 explanation 13, is it? So 43.1 is about cost. So in that cost, we need to this whatever is explanation 13 is typically you can if there is any assets on which depreciation has to be claimed, which on earlier assets, that you can claim it right now. So basically, when you say cost of asset, it is cost of asset. It is cost of asset and what you call cost of asset minus depreciation, whatever has been provided. Only thing is, if it is an asset which is covered under section 35AD, which is already claimed under 35AD, the asset value will be nil, right? Because you have already claimed it in 35AD. So typically, we'll take an example here itself for explanation 13. So let's take explanation 13 of 43.1. It is for 35AD assets. That is what will be the cost for this 35AD assets. So if you actually look at it, for these assets, that is, let's say this 20 lakhs and this 30 lakhs, since you have claimed 100%, claimed 100% deduction under section 35AD, hence cost under section 43.1 will be how much? Will be nil. So that's what is there. So typically explanation 13 of 43.1 is for assets which are available under 35AD. So if you have already claimed a deduction under section 35AD, you will not be eligible to claim depreciation. So which means the cost of such asset should be treated as nil. So that is explanation 13 of 43.1. Shankaran sir, I'm very happy that you are able to follow the lectures and do it. I'm very happy that you are trying out at this. So definitely age doesn't matter. Like I know a couple of people who have completed post-retirement and all. So all the best to you. I'm sure you will clear it at ease because you have the experience of understanding the concept. So it will definitely be easy. Geet, what is terminal depreciation? I think someone of you have asked in the last class also. So typically, I did not explain it through a separate slide or terminal depreciation. We'll just put it across like this. For any power generation unit, if that block of asset is typically sold, let's say the WDV is 100, okay? It is completely sold. For 80, okay? It is completely sold. This 20 is called terminal depreciation. So terminal depreciation is the balance depreciation during the last year of the asset used in power generation unit. So that's what is called as terminal depreciation. Akshat, can computer used in factory be allowed for additional depreciation? Yes, it is only office usage is not allowed. The computer is exclusively for factory. Yes, it is allowed. And we said 10,000 per day per person. He wants to know whether you can pay 5,000 each day for 10 days and still claim. Yes, you can claim. It is completely allowed because the provision doesn't restrict. But please, let's understand the concept of the provision. The concept of the provision is to discourage cash mechanism. So what we are trying to is to probably we can call these steps are tax escapism. So what we are trying to do is tax escapism, just to make sure we are paying less than 10,000 each day to a person various days. But the intention is to avoid tax on that, because I am not going to pay 50,000 in one single day. So typically it is not encouraged. It is not encouraged, but yes, income tax that cannot question the transaction. Sir, it is written in illustration 8 that profit of the business of setting up warehouse for storage before claiming if it was net profit from. So I'll go to illustration 8. So what does the question say? Under claim deduction and purchase of 50 lakhs, and however in February unit transfer. You're talking about illustration 6, is it? So I think it is about illustration 6. It only says before giving deduction, which means profit has already been considered, whatever is income tax profits. Just that we need to decide whether 35 AD needs to be provided and 32 needs to be provided. Dhyanesh, whatever done in accounting, we have to reverse first, then profit will be calculated as per income tax. Yes, correct. Basically, not every expenditure, for example, take depreciation. Book depreciation is not considered to be the right mechanism. We have a separate mechanism in income tax. So what we need to do is first we need to add depreciation and then reduce. So wherever there is a contradictory working for various expenditure, for example, expenditures like depreciation, scientific research, all these, first you need to add the expenditure and then again reduce it. For the rest of the thing, it might not be required if you have already done the treatment. Jyoti, why should we exclude land under section 35AD? Because 35AD says capital expenditure is allowed. You can claim 100% deduction, but it is not eligible for land, goodwill, and financial instrument. For these three assets, provision benefit of 35AD is not allowed. So that's why we are excluding this. Kavita, AD kya hai? So AD is what? Additional depreciation. Where have I said AD? I don't know where I used AD. Maybe 35 AD. I think it's 35 AD. 35 AD is the provision. I don't remember where I have written anywhere else. So maybe tell me the context in which where I've written AD. Generally, AD means additional depreciation. Here, I've said it as 35 AD. So under section 35 AD, you will have to do it. Pranav, yeah. Pranav, basically, yeah. See, my handwriting is very poor, but of course, now I have a limitation of trying to explain you at the same time of writing. So my focus is on explaining, not on my handwriting. So it will look more bad than what generally it is. But when it comes to examination papers, of course, I don't recommend these kind of writing, because there your focus is only writing. So which means you need to focus on writing it as much as what you call. If someone has to be read and understand. For example, these whatever I've written here, it's not something someone can read and understand, correct? It's not clear at all because I'm explaining and writing. So I have a different focus. I'm doing a multitasking. But as far as your examination comes, you're only going to write. So write it in a manner that someone else can read. That's all. It need not be neat, beautiful, great, nothing like that. Just that you should write in a manner that someone can read and understand. That's all it matters. Otherwise, it doesn't affect exam. So even if writing is bad, it is completely okay. Just that someone else should be able to read what you have written. So if that is possible, then it's completely fine. Okay. So with that, we will move on to today's session. Okay. So today's session, we'll discuss about rest of the provisions. Okay. So probably we'll discuss about section 35D to 40A. So we'll try to cover these sections in today's session. So we'll start with 35D. Okay. So 35D is typically called as preliminary expenses. So preliminary expenses is something like your pre-incorporation. So before incorporating your business, you might have to do some expenditure. Probably you will have given money to incorporate your company. You would have given money to do some project study or something of that kind. So these expenses is before incorporation. Even in 35AD, we saw pre-incorporation expenditure. We discussed about pre-incorporation in a couple of other sections. We discussed in section 35 and 35AD about prior to commencement. In 35, we said 3 years before, any expenditure incurred 3 years before, within 3 years, last 3 years, is typically salary and material cost alone can be claimed as a deduction in the year of commencement of business. So we discussed this in 35. In 35AD, we said anything which has been purchased or acquired before commencement, if it is capitalized on the date of commencement, it is eligible for deduction, correct? So this is exclusively for section 35 and 35AD. What about other expenditure, general business who are not eligible for 35 or not eligible for 35AD? How do they claim these expenditure? Because it is before commencement of business. So how do you still claim these expenses? For who is it eligible? What expenditures are allowed? How much is allowed? So typically these are the three questions that we are going to understand. We are going to understand about for who it is eligible, what expenditure are we going to claim, and how much are we going to claim as a deduction. So this is what we are going to understand. So first thing, for whom it is eligible. So it is eligible to an assessee who is an Indian company or a person resident in India. So which means it is not eligible for non-residents or foreign companies. It is only eligible for Indian company or a person resident in India. So typically an Indian company is a domestic company which is incorporated under Companies Act 1956 earlier or currently under 2013. So that's what you're actually calling it as Indian company. Person resident in India is non-companies, non-corporates who will be treated as a resident in India, be it a firm, LLP, an individual, whoever it is. So non-corporate will be considered. So that is who. Now, what should be allowed? What should be allowed? So expenditure incurred for prior to incorporation. Prior to incorporation is what we need to understand. So typically, when we say what expenditure, we need to say that it can be classified into two category of nature. One is you're introducing that you're starting a company or starting a business. So it's a new company. So that's the first concept. The second concept is it is an existing business. So it's an existing business. So now, how can we say that existing business can have prior incorporation expenses, pre-incorporation expenses, or as referred under 35D, preliminary expenses? So how can you say that someone will have a preliminary expenses? What does the word preliminary mean? Before you enter into some activity, you do some preliminary steps. So just before starting or just before commencing, whatever activity you do before that is called preliminary. That is the initial stage before incorporation or before setting up that activity. So if it's a new business, preliminary expenses means before commencement. So the key word is before, okay? Before commencement of business. That is, if it is a new business. If it is an existing business, it is an expenditure that is in connection to an undertaking because of which you're doing an extension, or you're setting up a new unit. So either you're setting up a new unit or you're extending the existing business itself. So this expansion or new unit will be called as an expenditure related to this is what is going to be considered as preliminary expenses. Okay. So now we know that must be an eligible assessee, which is basically an Indian company or a resident person who must have either newly set up a business, that is whatever expenditure he has done before commencement, or if it is an existing business, whatever activity that is relating to extension that has been carried out or before setting up a new unit. So this is what you are calling as preliminary expenses. So how much can you claim? You can claim 20% each year. So that 20% is nothing but you're going to claim it for 5 years. So what provision says is you can amortize this cost. What do you mean by amortization? It is like depreciation. So you are going to write off this cost for a period of 5 years. When you say 5 years, it is like 20%, right? So 5 years is nothing but 20%. But just that it must be successive previous year. And the first year will be the commencement or extension. So the year of commencement. If today is the commencement date, what date is today? 19, right? 19 November 2022. So this previous year 2022-23 becomes the first year. Okay, that becomes the first year. So the second year, third, fourth, fifth, right? So this will be what? 23, 24, 24, 25, 25, 26, 26, 27. So till 26, 27, you claim. So from 22, 23 to 22, 27, you will be eligible to claim 20% each year. That is what you're saying, 5 years. So 20% is nothing but you need not remember the percentage and all. Just remember that you need to reduce it for a period of 5 years. So that is nothing but 20%. So what is 5 years? If you wanted to remember 5 years, you can remember generally a year in which you enter into school, correct? Generally, all of us enter into first standard. Generally, we do third year, fourth year, we join LKG, fifth year, we join UKG. So after 5 years, we enter into primary school. That is, we start from first standard. So general age in which a person, general. I don't know if some of you have entered earlier or some of you have entered later. A general age for a kid entering into first standard, that is the basic schooling age, is after 5 years. So 5 years is typically, you can remember your own life cycle where after 5 years you started doing first standard, or however you wanted to remember. I'm just telling you a method of remembering. If you think this is not at all okay, not at all easy manner, you can think of something else to remember this number 5. So 5 years is what? Preliminary, right? So what are we doing in that first year? Preschool, LKG, UKG are all preliminary schooling. First standard only is the proper schooling. So that is why I'm trying to explain you the kids' education, preliminary schooling and schooling. So that's how I'm asking you to remember 5 with this, your schooling age. So please, if it suits you, you can probably remember it this manner. So how do you remember? Preliminary is like your basic preliminary education till 5 years old. That is your first 3 years of preschool and then LKG and UKG. So similarly, for preliminary expenses before properly commencing business, you can claim it for a period of 5 years. That is nothing but 20%. Okay. Now, moving on. We said it is 20%. Okay. So now when we say 20%, we said expenditure incurred for setting up a business, expenditure for expanding a unit, extending a unit, or setting up a new unit, right? So we said these 3 cases. Now we are going to go into the specific, exactly what expenditure is allowed. So it is basically on expenditure carried on by assessee or an approved concern. So either assessee themselves can carry or someone else on behalf of the assessee could have taken care of that activity. What is it? Feasibility report. So what is feasibility report? Again, I'll consider your first standard itself. We need to understand the parent. As a parent, let's say when letting me join first standard, my parent would have discussed about multiple schooling. They would have traveled across. They would have spent on fuel expenditure. They would have discussed with multiple people. Probably they could have taken some report online about which school is the best school across my area, all the studies. So where do you put your kid? So this is a decision, right? Where do you put? Or if you want me to understand, let's say join in CA or any other course, you would have taken a thought, which course should I do? Should I do CA or any other course? So how is it viable? How is it good for me? So this is called feasibility report, whether you can do or you can't do, whether it is good to proceed this or not to proceed this. So you take comparisons, you take this for this, you do some step extra effort. So this is called as feasibility report. So if I wanted to talk about business terms, let's say I wanted to set up a business of manufacturing sugar, I need to know which area it is viable, how it is viable, whether it will be profitable, which year I'll start making profit. So all this is typically called as feasibility report and project report. So both is something like similar terms. Feasibility is whether it is possible to do this. Project report is what will be this event after that. If I do this business, what will be my profit? Which year I will start making profits? All this is called feasibility and profit report. And then market survey. Market survey is typically public opinion on how will it work if I set up this in this particular location. It could be a cinema theater or supermarket. If I set up in this location, will people come to this location? So I do a market survey, whether there is a demand, whether there is a requirement in this area. So this is all called as survey for business. And any engineering service like setting up a machinery, setting up a particular equipment, all this will be called as engineering services. So all these expenditure, whether done by yourself, that is assessee themselves, or through an approved concern, it is eligible. Okay. So it's something like to decide whether to do it or not, how to do it. So this expenditure is basically called as preliminary expenses. And then any legal charges, whatever legal charges for any agreement drafting or whatever it is, whether by yourself or by an approved concern, it is eligible. So this is applicable for all assessees. So not just company, it is applicable across the person, individual, HUF, whomever you wanted to talk. This is an eligible expenditure categorized as preliminary expenses. But when it comes to company, it has some additional expenses apart from whatever we discussed right now, some extra expenses such as setting up the business requires some certain, certain templates or certain documents which are mandatory. So some of the documents are memorandum of association and articles of association. You would have all read it by now. When you form a company, the base document of a company, the Bible of a company is these two documents. There is memorandum of association and article of association. So preparation and printing of that, let's say you need to print 20 copies, 30 copies to each shareholder. So whatever cost you incur, and fees for registering the company, whatever you pay to Ministry of Corporate Affairs for registering the company. So that registration charges, underwriting commission, brokerage, or whatever it is for prospectus. What do you mean by prospectus? When you're going on a public issue, okay, IPO, initial public offering. So when you're going on an IPO, you might have to incur some expenses as underwriting commission, brokerage, and charges. So all these expenses, whatever we are talking here, is called as exclusively for companies. So these expenses are eligible as a preliminary expenses exclusively for company. If you see this, all this is relating to setting up, be it memorandum of association, articles of association, registering the company, underwriting commission, brokerage, or whatever for public issue or IPO. All this is what is exclusively for companies. That is why it is called as preliminary expenses. And most of the clause will have this clause. Most of the clauses, sections, will have this clause where it says other items as may be prescribed. This is basically to give power to income tax to include few more items without disturbing the provision. So you don't go and amend the provision, but still you give through a notification or circular saying that this will also be included as preliminary expenses. So it is basically giving power to the tax authorities to include few more items. But as of now, there is none. So there are no items as of now that has been prescribed. So what should be remembered is only this and this. So only these two that should be remembered. That is for all assessees and companies. Now, we know who is eligible, what expenditure exactly it is eligible, and we know you can claim 20% of such expenditure. Now we are going to understand about the limit. We are going to understand about the limit. So can we say whatever I incur is eligible as preliminary expenses, or is there any limit? Yes, there is a limit. Yes, there is a limit. So typically it is, if it is a company, the limit is 5% of cost of project or 5% of capital employed. Higher of 5% of cost of project, 5% of capital employed. No qualifying limit. If it's other assessee, it is only 5% of cost of project, because there is no concept of capital employed. There is no concept of capital employed in other businesses. You might call it capital, but technically it is not third party's money. Partner's money into same business. So partner is the owner of the business, HUF or individual. It's like I'm doing business with my own money. I'm not doing business with third party's money. Only in company where you have third party's money, strangers' money being pulled in, and you might do a business. So that's why there is a restriction on company, which is 5% of cost of project or 5% of capital employed, whichever is higher. Whereas for all other assessments, it is only cost of project. So now what exactly is this cost of project? Cost of project is the cost of fixed asset. Cost of fixed assets of that particular project. Okay. If it's a new company, the company. If it's a unit, that unit. And what is cost of capital employed? What is cost of capital employed? Whatever is my share capital, whatever debentures I have issued, whatever long-term borrowing, that is more than 12 months period, which are repayable for a period more than 12 months. So share capital plus debenture plus long-term borrowing. So all these three is what is called as cost of capital employed. Again, if you wanted to remember it, I don't think you need to remember at all. Basically, what is called as capital, the share capital, but even debentures are form of shareholders only, just that they are loan holders. Rather than you call them shareholders, they are loan holders, but they are also like actively part of your business, who have contributed money to do your business. So that's why you are including debentures. Same way with banks who are giving you loans for like a term loan for 5 years, 10 years, which means they have also funded you to establish something. Please remember all these three, whatever we are talking here is an expenditure that is spent to establish a business. That's why we are calling as cost of capital employed is share capital, debenture and long-term borrowing. No other cost can be categorized as establishing a business. Others could be working capital, current asset, current liability, whatever it is, but they are not cost for setting up a business. So that's why it is cost of capital employed. Please understand why the provision is in place. Why is there a definition of that angle? Understand the concept, not just as a formula of cost of capital employed is equal to share capital plus debenture plus long-term borrowing. Don't do this, because it might be easy for just remembering it today, not tomorrow. We wanted to remember in a manner that we can remember today, tomorrow, thereafter. That is what will help you for the examination. So whatever you are remembering should be remembered in a manner that could be helpful for rest of the period. So how do we understand cost of capital employed? It is a cost that is used to set up business. What are the costs that could be used to set up business? It will be share capital, it will be debentures, and it could be long-term borrowing. This is what is used. So that's why we call it as cost of capital employed. So 5% of cost of project or cost of capital employed, whichever is higher. You take this, that is the maximum, which means whatever eligible expenditure that they have incurred cannot overboard this 5%. So it is restricted. It is restricted to 5% of cost of project or cost of capital employed, whichever is higher. This number is only will be claimed for 1/5 of qualifying limit will be claimed for 5 successive years from the first year of commencement of business. Okay, so this is what section 35D is about. So please understand the concept of provision. Please do that. Don't just try to by heart or mug up the provisions. It may not be helpful for legal subjects. It may not be helpful during your examination. So please understand the concept. Try to remember linking with something else. I might tell you a method which is not good. For example, 5 years of preschool and thing might not be a relevant case for you. You might think something else for 5 years. Try to remember the number linked to something like mind mapping or mind palace. Try to remember it with some methodology. That what will help you remember for a longer period. As I told you, today, tomorrow, and forever. Don't try to do something for today alone. It will not be helpful. Okay. I try to mix these tips now and then when we discuss it about. I hope these are helpful to you. So with that, we are done with 35D. We will try to understand another similar provision for which you can claim over a 5-year period. So same 5 years, same 5 years. So remember the 5 year that continues for voluntary retirement. So 35DDA is a section which is called as expenses for voluntary retirement scheme. What is voluntary retirement scheme? Let's say a company has a retirement age of 60. Okay, we'll assume a company has a retirement age of 60. So retirement age of 60. But company feels they need more young population. You would have all learned people sacking in various organizations and other things, dropping off old employees, aged employees. For example, there are many businesses. For example, in banking business, when computers were introduced, banking people felt that old staff are not capable of handling computers. They thought so. And they said that for some of the old people, they said, you may retire. I'll pay you whatever you're due for the entire retirement period. If you say for the next 5 years, you're eligible for this salary, I'll give you the entire salary today itself and leave you off. So I'll give you all the benefits and leave you off. So just that, taking away an old employee and trying to recruit a new employee. So this is some policy followed by certain companies, right? You would have studied this in salary also. How do you treat it? How do you tax it in the hands of employee, Now we are talking from the person who has given us this job. That is from the employer's perspective. So as far as an employee, whatever bulk money, whatever settlement is giving for this voluntary retirement, he can claim it as 20% for 5 successive years from the first year of such payment. So if today I have given it for 20 employees, this total cost, let's say for each employee I've paid 10 lakhs. So 20 employee, I've spent 2 crores. This 2 crores can be claimed for a period of 5 years, for the next 5 years from this year onwards. So generally a retirement age is 60. I'm requesting, let's say, as to retire yearly, let's say at 56 itself. So now I'm asking someone to retire at 56. That's why it's called voluntary retirement. Sometimes it need not be the company doing it. If there is an option available, sometimes the employee themselves could go and say, see, I have various personal reasons. I'm not able to continue thereafter. So let me retire. Let me retire at 56 itself. Let me not hold on for next 4 years. So this is what there. If you want to remember, you can think of cricket also, right? Cricket, you remember even in Dhoni's movie, Dhoni said, I don't want old people because I need new generation for 2011 Cricket World Cup. So this is a typical mindset of so many people who feels that old people cannot contribute more, so I need new generation. So either the company could send you off or you yourself as an old man could have a reason for retiring it early. For this voluntary retirement, whatever company is spending, you can claim 20% for a period of 5 years. So that is voluntary retirement. Okay, so with this, we have completed this concept of claiming an expenditure for 5 years, that is preliminary expenses and voluntary retirement. I'll take some questions on these sections and then continue with the next section of 36. Dhyanesh, yeah, fees to ROC is basically called as what you call is an preliminary expenses, which is to set up a company. Not every year annual filing fees is not preliminary expenses. To set up a company is what you call it as a preliminary expenses. Kavita, who's non-corporate? Anyone who's not a company, a private limited or limited. So company, right? And assess, you have different persons. You have individual, you have HUF, you have firm, LLP, AOP, BOI, and artificial judicial person. And then you have company. So other than company, all 5 people are called non-corporate. Abdul, is it allowed to R and OR also? Yes. They must be a resident. Doesn't mean they're not ordinary resident or not. They must be a resident. Dhyanesh, what is the meaning of amortization? Amortization, I think Doshi has also requested. See, amortization is something like depreciation. You write off. If you have spent 100 rupees, you are writing off 20 rupees every year for next 5 years. So amortization is kind of writing off. It's like retiring that expenditure. It is like retiring that exact meaning should be like retiring that expenditure. But to remember it easily, it's like write off. It's like depreciation. Kavita, yeah, 20% is a fixed rate because you have to do it in 5 years. No, nothing doing. You will have to do it in 5 years. So since you have to do it in 5 years, it is 20% every year. Yeah, Jodi, the 5 years starts from the commencement of business. IPO is initial public offering. So basically, most of you, I think all of you would have ordered on Zomato, Swiggy and all, right? Zomato recently came out with this listed. So from being a private limited, they were listed in the stock exchange. So this process of becoming a listed entity on a stock exchange. So this is called IPO, that is initial public offering. That is called as public issue. So for the first time, you are issuing shares to public. Not the first time. Whenever you are issuing shares to the public, it is called as public issue. When you are doing it for the first time, it is called as initial public offering. Something what like Zomato. And if some of you might know Nykaa, right? You would have bought cosmetics from Nykaa. So they also recently listed. So such companies or a private limited currently getting listed in stock exchange. So this conversion is what is called as IPO. Okay. Abdul, why deposit is not included? Deposit could be even fixed deposit or whatever. These are short terms. So that's why we are not including deposit as capital employed. Pranav, yeah. Capital employed is debt plus equity. Just that debt is only long term like debenture and long term borrowings. Rishikesh, qualifying limit is basically a restriction, okay? Whatever expenditure like your legal drafting, market survey, feasibility report, project report, all that expenditure you have taken, okay? But now this expenditure, now we'll take an example actually. So typically, let's say my feasibility report is 10 lakhs. And setting up company, that is incorporated, registering MOA, AOA, everything is, let's say, 5 lakhs. Okay. So totally I have spent 15 lakhs to set up my business. I have spent 15 lakhs to set up my business. Now we say this 15 lakh is an eligible expenditure. But let's say my cost of capital employed is what you call is 10 crores. Okay. So I need to compute 5% on this. Okay. So how much will it be into 10 crore into 5%? It will be 0.5 crores, right? That is, I'll try to work out 10. So that will be 5 lakhs. Okay, 5 lakhs. Now, my qualifying limit is restricted to 5 lakhs. My qualifying limit is restricted to 5 lakhs. So, I cannot claim 15 lakhs. I can only claim 5 lakhs because it is restricted to 5% of capital employed. Just that, not just capital employed, you also have to take cost of project. Let's say my cost of project is 1 crore. 1 crore into 5% will be how much? I'll have to take 10, right? So it will be 50,000. Now in this, I take whichever is higher. So I take this 5 lakhs and it is 5 lakhs or eligible expenditure, whichever is lower. So 5 lakhs. It's something like your house property, right? Standard rent, fair rent, your actual rent. You compare whichever is lower and then you compare whichever is higher. So all that method. Similar method. But to remember it simply, maximum preliminary expenses that you can claim is 5% of cost of capital employed. So that's the maximum expenditure you can claim. 35D audit of accounts date is given. Abdul, it will covered in the next slide. Is corporate tax same as income tax in company, or it has some other provisions? It has some other provisions. You will see that in final. There are various provisions exclusively for corporate companies. We will definitely see that in final. Abdul, even if deposit is for 36 months, it does not qualify as a debt or something. So only debt and equity is considered. 50 lakhs is it? I'm sorry. When I do this correction, I have actually calculated as 5 lakhs, and you have corrected me, Abdul, Anish, you have corrected me that it is 5 lakhs. So typically, these two, whatever I've written wrongly, right? So when you're trying to solve a problem and then correcting it, like you see it in the study material and see whether your answer is correct or not. So you have first solved it on your own, and then you are seeing the book material, you're understanding that you have done some mistakes. Now, how do you correct it? When you wanted to do it, just use another ink, a different thing, preferably red, to point out mistake. So now what you do is you do this, multiply it, and then write the correct answer in the red ink. So which means next time when you are going through your rough note or working note, you will know that you have made a mistake and you have corrected it, which means it will go into your mind when you're using a different color. When you're using a different color, it will stay in your mind and it will not let you do this mistake again, because you've used red, which is alarming, So when you wanted to correct something, use red and correct in your working sheets, not in your exam sheets or something. I'm only talking about while working in your preparation mode. So during this preparation mode, whenever you're making a mistake, try to correct it using a different thing, preferably red, which means it gives you an alarming mistake that your mind will tell you, don't do this error again. So this will help you solving the problem better, getting efficient, becoming efficient. This will help you becoming efficient. Okay. Now, if this is 50 lakhs and 5 lakhs, of course, what will happen? What will happen is your entire eligible expenditure is allowed. So this itself is allowed. So you need not do anything. So this entire expenditure will be allowed because your eligible expenditure is less than the 5% of cost of capital employed. Jyoti, what is cost of capital employed? I think we just discussed, right? We discussed about why debt should be included. So basically, it is debt plus equity. That is nothing but your share capital, debenture plus long-term borrowing. So I told you not to remember as a formula. So if you wanted to remember it as a formula, still, I can't help it. But if you wanted to remember it as a formula, cost of capital employed is equal to share capital plus debenture plus long-term borrowing. If you wanted to remember the concept, cost of capital employed is whatever cost is required to set up the company, the basic debt and equity that is used to set up the company, not your current assets, current liability, or working capital. So that's what it is about. Okay. So we'll move on to the next thing. I said we have completed the thing. Oh, I don't have the audit portion, is it? I thought I had somewhere. Okay, I'll tell you. This 35D, 35AD, I think we discussed in the last class, right? The audit. So that, okay, that's why one of you have questioned. Okay, one of you had wanted to know, is there any audit account, the date given? Basically, 35D accounts must be audited. 35D accounts must be audited. So there is no separate form and all, but it must be audited accounts. So just to clarify that what is eligible expenditure, what is cost of capital employed, it must be an audited accounts as far as the thing. And the date is, of course, before return filing. So that's what audit of books is all about. Okay. So I don't think there is nothing else that we need to discuss about audit. So basically, the books must be audited based on the due date given in your income tax itself. Whatever it is what is applicable. So when we see this return of income, we'll know the due dates for audit. That date only is applicable for 35-day, but we can ignore it for time being because we'll see that while seeing return of income. So books must be audited for whoever is claiming 35-day expenditure. Okay. Next section is 36. Okay, 36, which is basically called as other deduction, other deductions. So whatever we saw right now, whatever we saw till now, that is 30, which is RRR. We spoke about the movie RRR, that is rent, rates and taxes and repairs and maintenance and insurance of building. Then 31 is rates and taxes, repair and insurance of plant and machinery and furniture. Then we spoke about 32, that is depreciation. Then 35, scientific research. 35 AD, your specified businesses. 35D, preliminary expenses. 35 DDA, it is voluntary retirement. All these 7 sections, whatever we discussed till now, is relating to specific depreciation, voluntary retirement, preliminary expenses. Now we are going to see a section which has multiple expenditure in the same section. They are just saying these expenditure are generally allowed. These expenditure are generally allowed, provided they satisfy certain conditions. Okay. So first expenditure is insurance. So one of the first expenditure that we are going to discuss about in this section 36 is insurance. So we already spoke about insurance for building under section 30 and plant and machinery and furniture under section 31. We said building or be it plant and machinery or furniture, insurance can only be on one topic, or if you want, you can say 2 topics. It is damage or destruction. Damage or destruction. You cannot claim insurance for any other matter. So it can only be on either damage or destruction. For section 30, it is damage or destruction of the building. For section 31, it is damage or destruction of plant and furniture. For section 36, it is damage or destruction of inventory or stores. So that is what is the risk of damage or destruction of stock or stores. So damage or destruction of stock or stores used in the business. So that's one insurance. Or if not, it must be for the health of the employees. That is medical insurance. Medical insurance for employees, for the health of the employees. That premium is allowed, but it must definitely be paid in banking mode or prescribed electronic mode, not cash. Please remember, it is not cash. So premium paid in by cash is not allowed. Same applies in ATC deduction. When we see that, I think you have not covered it right now. So whatever has been covered right now, we'll discuss that. Cash is not allowed. Not like 40A3 where there is a limit of 10,000. Here we are saying any cash premium is not allowed. It must definitely be on prescribed electronic mode. This is only for health of the employee. So that is what it is about. Okay. Next thing, we are going to discuss about contribution to provident and other funds. Provident fund and other funds. You would have discussed elaborately about this provident fund in the chapter salary. Again, that is from the employer's perspective. What about this final retirement when he resigns or retires? What happens to the provident fund that he receives? What happens to the gratuity he receives? What happens to the leave encashment that he receives? What happens to the voluntary retirement? All that you would have studied in your salary. Here, what we are going to talk about is for an employee to receive that provident fund pension or whatever it is, for them to receive, employer must be contributing it to a fund. Only then provident fund is eligible. Now, there are 2 types of contributions for provident fund at least. It is called employer contribution or employee contribution. Okay. So first is mandatory savings. So employer and employee. So there is a different set of rules for employer, different set of rules for employee. So what does employer says? Any contributions to provident fund, superannuation, or any recognized fund or gratuity, whatever it is an allowed expenditure. So whatever contribution is being made on definite basis, which means there is a fixed amount which is deposited into a fund. So that definite amount is what is allowed as an expenditure under section 36, 1, 4 and 5. Exclusive benefit of employee. This fund, whatever is being set up, should be for the exclusive benefit of the employee. So that fund whatever money is being deposited into this fund will be eligible for claiming deductions. It does not talk about any payment dates. Typically, please remember, it must be paid on or before the due date of return of filing the income. So let's say for individuals, 31st July is the due date. So any individual business, a general individual, normal individual who are not subject to audits. So this individual business, to claim this as an expenditure, employer's contribution, he must remit it to the government. He must remit it to the government on or before filing his return of income. So if he is filing his return of income on 31st July, he should have paid the employer contribution of provident fund on or before 31st July. So that is for employer contribution. That is for employer. That is for employer contribution. What about employee? For employee contribution, it must be paid. It might be paid on or before the due date of the relevant fund. Generally, the due date for PF is 15 days from the close of every month. So if you are talking about contribution for October, it must be deposited before 15th November. So that's the general deadline, not any extended deadline. The actual deadline, actual due date only should be considered. So for employee contribution, the condition is such contribution should be paid into the fund on or before the due date of the relevant fund. Now, it might be difficult for you to remember which fund is important. Employer fund as the strict due date or employee as strict date. Your mind get confused, right? I'll tell you a method to probably remember. Employer's contribution is employer money. It is employer's money, which is additionally given for employee. So it is an employer's own money. Employer's money is being contributed to provident fund, but employee contribution is employee's money. So it is employee's money, which means if I'm not paying into within the due date, which means I am misusing the funds. Because let's say the due date of salary is 31st October, I would have reduced from a salary saying that on behalf of you, I'll pay it to provident fund. Now this 31st October money, government itself is giving you 15 days time. But let's say you are paying it on 10th January, which means you have misused the fund between this period, right? You have misused the fund between this period. You have played with employees' money, not your money, which is not acceptable. So it is very strict. So employer contribution is employer's money deposited into the fund. So there is a cushion, there is a comfort zone, which says you are free to deposit on or before filing your return of income. But when it comes to employee contribution, it is very strict. It says it is not your money, it is employee's money that you are depositing. So we will not give you any relaxation. You have to deposit within the due date specified in the Act. Otherwise, you are not eligible. You are not eligible to claim this as an expense. So which means even if there's 1 day delay, for example, instead of 15th November, if he is depositing on 18th November, even for this 3 days delay, entire expenditure will be disallowed. Entire PF contribution will be disallowed. It is very strict. So that's what this provision is about. So with this, we'll take a short 10-minute break and then come back and continue with the rest of the session. So we'll see after 10 minutes. Yeah. So, welcome back to the session. So, I'll just answer a couple of questions which has been posted across. Difference between 35 AD and 30D. 35 AD is for specified businesses who are incurring capital expenditure. It's a completely a different concept. Specific business, we saw the illustration, food, grain, sugar, other industries like cold storage, infrastructure facility. For these businesses, 100% of capital expenditure is claimed as deduction in the year of expenditure. But 35 AD is preliminary expenses. That's why I'm talking about the schooling age. Like before you do this first standard, you do this first 5 years is like preliminary education. It's like preliminary education. So this 5 years is only what is going to be contributing to the first standard and onwards. So whatever that expenditure is like your preliminary expenses in your own personal life, whatever has been incurred for the first till your kindergarten. So that's what is actually called as your preliminary. So preliminary expenses claimed for 5 years. So that is what 35 AD. 35 AD is your specified businesses, which is specifically for certain businesses, 100% capital expenditure. Murtasha, what is the capital employed in case of extension business? That's a good question. See, that's why there is this concept of cost of project or cost of capital employed, whichever is higher. So typically, even for extension business, it is cost of capital employed, the original cost only. You need not go into the specifically for that project and all. At any time, it is cost of capital employed for the whole business as a whole. It is not the unit, because share capital is not unit based. It is a business as a whole. So you need not split anything. Sorry. Abdul, cash premium for insurance stock is allowed? Yeah. But anyways, if you see in general provision, more than 10,000, that expenditure is not allowed. So even if it is paid in cash, whatever is being the premium, if it is more than 10,000, it is not allowed. For medical insurance of this employees alone, even 1 rupee is not allowed. So that's the only difference. Though she zero coupon bonds. See, when I buy zero coupon bonds, it's an asset to me. So whatever we are talking is only on the liability side, debt plus equity. We are only excluding current liabilities, provisions, all those things. So whatever we need to consider as capital employed is share capital plus debenture plus long-term borrowing. Subhash is, yeah, to any contribution to unrecognized provident fund is not an eligible expenditure. Abdul, yeah, statutory provident fund is also a recognized provident fund, but it's only for typically for government employees. So, but it's still a recognized fund. Rushikesh, from where will I get the above notes? I upload it. I upload all the slides and notes immediately after the session is over. So, yeah, so we'll proceed further to the next section, next category of section 36. So, we already saw insurance, that is of stock and medical employees. And then we discussed about your PF fund, other superannuation, gratuity and other funds, employer and employee contribution. As we said, employer is relaxed, which means you can pay up to due date of filing of return. But when it comes to your employee, it is very strict. It is mandatory that you pay it within the due date of that relevant fund. So for PF, it is 15. So the due date becomes 15. So that's what it is about. Okay, we'll move on to the next concept of section 36. That is your bad debts. So the next important section in bad debts, it's 36 clause 1, subclause 7 talks about bad debts. When is bad debts allowed as an expenditure? So when can you claim bad debts as a deduction? So I'm sure that most of you here, or almost all of you here, if you recollect your basic accounting from your early education of 11th standard, 12th standard, which is typically, your concept of bad debts would have been discussed. So what is bad debts? As the word says, it is a debt which has become bad. It is a debt which has become bad, which means it is no more recoverable. So any collection, any receivable to you in the debtors is basically become bad, which is you need to write off. So you decided to write off. So whatever amount of any bad debt which is written as irrecoverable. So which is basically bad debts are irrecoverable in the account is allowed as deduction. So it is eligible. Now, what are the conditions attached to it? The first thing is it must be incidental to the business of the associate, which means whatever data that you have booked should be for the purpose of your own business, So if it is not relating to your primary business, then it cannot be allowed as a bad debt. So which means it must be relating to a debtor for a day-to-day operation. So it must be on the regular operation of business. So that is what bad debt on such debtors is only eligible to be claimed. And similarly, bad debt has been considered for computing income of that previous year or earlier previous year. So the income, when we say it must be incidental to the business, that income need not be this year's income. It could be earlier year's income also, because it is lying in debtor. So in that year, you would have claimed that income. So the basic concept of bad debt is, I have already paid tax on that income. Now, if I say it is not recoverable, which means it is not my income, So I need to reduce it, my profit, and treat it as an allowance. So this allowance is typically, it could be income of this year or any earlier, just that it should have been reported as an income in one of the years, current year or any earlier year. So that's the only condition. And then the debt should represent money lent. In case if it is relating to finance, loan or something, it should be money lent in the ordinary course of business, which means my business itself should be in the business of money lending. So anyone else cannot write off loan. Any other person cannot write off loan unless their basic business activity itself is funding. So basically, banks and NBFC alone can write off loans. As a businessman, you cannot write off loans because lending loan is not your primary business activity. So only the income can be recognized. Otherwise, to write off a loan, your primary activity itself should be in the business of lending. So these are basic conditions, right? So if you actually look at it, bad debt should be incidental to the business. You need not even remember this condition. It's a very basic condition. Similarly, just because it is an income in some year, I would have paid a tax on that. Now I'm saying it is not recoverable, which means it's no more an income to me. So I'm writing off. So I'm claiming allowance. So the second point is also kind of automatic. It need not be separately mentioned or something. And the third point, it's basically to make sure that people don't write off loans. Lent. So to restrict that, they're saying you can write off loans only if your primary activity is money lending. Otherwise, you cannot do it. Okay. And the last condition is very critical because it says no requirement to establish. So which means I need not prove to the income tax authority. I called 10 times. I WhatsApped him 100 times. I also telegrammed him. I sent him in Instagram, Facebook. Nothing needs to be proved. You only have to treat it as bad debt. So it's up to you to say whether it is a bad debt or not. No one needs to, you need not prove it to anyone that it is actually a bad debt, which means you tried, but you cannot collect it. So this proving need not be shown. So nowhere you need to establish that the debt is irrecoverable. So it is not required. So there is no requirement that the debt must be proved to be irrecoverable. So this is what it is. Why? It is very easy, right? I can just say my income is a bad debt. So every year I can contribute some portion to bad debt and keep claiming it as an expenditure. It's very easy, right? So, and I can very much save tax, or you can call it as evade tax. So why is this relaxation of saying that you need not prove it to say that it needs to be recovered or not recovered? So my point of view is, whenever it is subsequently recovered, there is a treatment mechanism in income tax. So this year I say it is bad debt. Subsequently, if I am recovering it, there is a methodology to treat it. So that is why government is not bothered about proof, bothered about evidence. They just say, if you wanted to treat it as a bad debt. Subsequently, when you are receiving it, you treat it as an income again. So this is what they are saying. So in this, there are a couple of categories in which we are going to discuss. I'll first explain it with an example. We'll take a bad debt. So bad debt. This bad debt, let's say, I'm going to explain in previous year 2021, I made a sale of 5 lakhs. Okay, I made a sale of 5 lakhs. Now, in previous year 2022-23, it is lying as recoverable. That is, it is lying in debtors. So my sundry debtors as a number of this 5 lakhs. Okay, my sundry debtors as this number of 5 lakhs. In this previous year 20 to 23, I feel this amount will not be recoverable anymore. So I feel that a part of it will not be recoverable. So now I think, or I'll call it as irrecoverable. Irrecoverable, recoverable. Okay. So I feel 60% is irrecoverable. Let's say 3 lakhs. And I say 2 lakh is recoverable. So I will recover 2 lakhs because that guy has promised me, sir, I don't think I can pay you 3 lakhs. If you are okay, I'll at least settle 2 lakhs. Otherwise, leave me. I'm going to run away. I'll not pay you even 1 penny. So if you're okay, I'll pay you 2 lakhs. Otherwise, I'll not pay you anything. It's up to you. So as far as I am concerned, I'm very happy. At least I'm going to get 2 lakhs. So I say, okay, you at least settle me 2 lakhs. Now what I do is, in this year, I will treat this 3 lakh as bad debts. Okay, I'll treat this as bad debts and reduce it from my profits. I claim this as a deduction. I'll claim this as an allowance, saying that this 3 lakh is no more irrecoverable. This is happening in previous year 22-23. So there is no doubt about it. Now, in previous year 2023-24, in previous year 2023-24, this person we are receiving, we'll say receipt. Receipt against this is 4,60,000. So what has happened is I have received 4,60,000 where I thought I'm only going to receive how much? 2 lakhs. I thought I'm only going to receive 2 lakhs. So I wrote off 3 lakhs. Which means I have recovered excess than what I thought that I will recover, correct? So now the question is, we need to see whether it is excess or short. So we know it is not short because it is only excess. So how much is excess? Excess of 2.6 lakhs. So earlier I have treated this as a bad debt. How much? 3 lakhs. But the bad debt is not 3 lakhs. It is only 40,000 because I've recovered 2.6 lakhs also. So in that year, in this year, it will be treated as a deemed income of 2,60,000. So this is if I'm recovering in excess. Okay. Now, we'll take this example. Okay. We'll take this example. I'll just keep this in some other color. Now, what is happening is this particular year, in this example, we'll just imagine that my receipt was not 4,60,000. My receipt was not 4,60,000. My receipt was 1,60,000. My receipt was 1,60,000, not not 4,60,000. So I'm going to treat in the second scenario. So now is this excess or short? It is not excess. It is short by how much? It is short by 40,000. I thought I will at least get 2 lakhs, but this guy has paid me 1,60,000 and he's ran away. I don't even know where he is, which means there is a further bad debt, additional bad debt of 40,000. So in this case, this will be treated as a fresh bad debt of 40,000. right? So, which means I am going to treat it as a bad debt this year. Subsequently, if I'm going to receive excess, then in that year I'll treat that excess as income. If I'm going to receive it as short, in that year I'm going to treat it as an additional bad debt. Clear? So this is the concept. Please remember how I'm going to treat it. I'm going to treat it as a bad debt. So now we'll go back to that. Okay, now we'll go back to this. I have given this like a formula. I've given this a formula. So if the debt minus deduction allowed, So in our example, in the second example, in this example, our debt is how much? 2 lakhs. Debt is 2 lakhs, but my deduction allowed is 1.6. My deduction allowed is 1.6, which means 40K, 2 lakhs, 1.6 lakhs. So which means 40,000 will be created as a bad debt. So the shortfall, which is nothing but what? This money is an additional bad debt. So this is what is the another clause. That is, there is a shortfall. Now, what if ultimate recovery is more, which is what we discussed in the first category, first example. What did we say? My debt is again 2 lakhs, but how much I have recovered? I have recovered 4.6 lakhs. Correct? I have recovered 4.6 lakhs. So, which means the excess of whatever I thought I have already treated as bad debt. I have already treated 3 lakh as bad debt. Now I have received 4.6 lakhs, which means I have recovered 2.6 lakhs, which I thought I will not recover. So my actual bad debt is only 40,000. So 2 lakh minus 4.6 lakh is minus 2.6 lakh, correct? Minus 2.6 lakh. So this is a deemed income. So the excess is an income. So very simple, straightforward, correct? I am treating something as a bad debt because I think it is irrecoverable. I need not prove it to anyone. Subsequently, I am receiving some money out of the debtor. If it is short, the balance will be treated as further bad debt. If it is excess, the excess will be treated as deemed income. So all you need to do is identify whether the ultimate recovery is positive or negative. If ultimate recovery is positive, it is a bad debt. If the ultimate recovery is negative, which means it's a deemed income. So this is all about section 36. Now that is about bad debt under section 36. I'll see if there are any doubts on bad debts alone. Abdul, should that be proved by the auditor? No. The books of accounts under section 35D must be audited. That's all. Nothing else. In the books of accounts, you would have accounted something called preliminary expenses. That is completely okay. Renu, the excess is 1.6. It's typically not the excess above 3 lakhs. So if you actually thought in this example, whatever we wrote here, initially we thought debtor is 5 lakhs less bad debt. I am treating as bad debt. So my new debtor is 2 lakhs. Correct? My new debtor is 2 lakhs. Now in this 2 lakhs, I am actually receiving 4.6. So now the new debt is 2 lakhs, but recovery is 4.6 lakhs, which means minus 2.6 lakhs is excess. So this is what you treat it as deemed income, correct? So in another case, in this case, it is typically like debtor is 5 lakhs minus bad debt was 3 lakhs. I thought it is going to be 2 lakhs. But what is actually happening is, my new debt My new debt here is 2 lakhs. My recovery is only 1.6 lakhs. So short of 40K, that is 40,000. So this will be treated as a bad debt. So that's what we have defined here. Okay, clear. Good. Okay. So now we'll move on to the next topic. In 36, we discuss specific things like insurance, provident fund, superannuation, gratuity, bad debt, all this we discussed. I think there is one more section, clause 7A, which is on bank bad debts. I'm not covering that. Probably when time permits in the last class or the last session, we will cover that. So as of now, we'll cover the other 36 things. We are going to talk about bonus or commission. So whatever is actually being paid as bonus is an allowed deduction. So paid to employee for services rendered, it is allowed. Just that it should not be a bonus to a specific person who has some shareholding and all. So you're just using dividend as what you call a mechanism to save tax. So you are just distributing as a bonus instead of calling it as a dividend. So that is why it is basically bonus or commission is whatever is paid is allowed. Just that we should make sure that that expenditure will otherwise not be distributed as dividend. So that's the bonus and commission. Okay. Next is interest. Whatever is interest for the purpose of business, carrying on the business will be allowed. Just that if it is towards an asset, till it is first to put to use, we saw in explanation 8 to 43.1, it will be capitalized. Every other thing will be treated as revenue expenditure. So when it comes to interest, if it is towards fixed asset, till it is first to put to use, it is capitalized. Every other interest will be treated as an interest expenditure, which is allowed as a deduction. Okay. Discount on zero coupon bonds. So basically, what is zero coupon bonds? There is no interest. So when you are basically, you will be paying a discount. So if your bond value is 100, you will be paying only 96. So when you're receiving, you will receive 100, but the bond value is 100. So whatever received minus payable on maturity. So if received is 100, whatever was paid is 96. The 4 rupees is the discount on zero coupon bond. That will be considered as the deduction on pro rata basis. Let's say it's a 5-year bond. Every year, equally, you will distribute this 20% of 4. So depending upon the number of year of the bond, you give the discount on pro rata basis. So you allocate discount for that respective year. Pension scheme, there is a scheme called 80CCD. We will see that in we'll see that in deduction. It's called National Pension Scheme. Okay, both the employer and employee can contribute to this particular fund, to this national pension scheme. But when employer contributes, so as I told you, both of them can contribute. Employee and employer. But there is a restriction on employer's contribution, that is 10% of salary. So up to 10% of salary you can claim. So what is allowed is 10% of salary. So up to this amount, it is okay. Anything above that, it is not allowed. It is disallowed under a section called 40A9. So what is allowed under section 36 is up to 10% of salary. What do you mean by salary? It is basic plus dearness allowance, and it does not include anything else. It only includes basic and dearness allowance. So next is family planning. Again, 20% of 5 years. Do you remember how many times we are seeing this 5 years? Whenever there is some bulk expenditure, we are seeing this term 5 years. We saw it in 35D, preliminary expenses. We saw it in 35DDA, voluntary retirement compensation. Now we are seeing it in family planning. A family planning expenditure incurred by employee will be claimed as a deduction for 5 years. So any expenditure on promoting family planning will be claimed as 20%. The unabsorbed is similar to your unabsorbed depreciation, unabsorbed scientific research. So everything like that. So which means can be carried forward for unlimited years. So So whatever is unabsorbed will be carried forward. So family planning, but just remember, it is only for companies. It is not for anyone else. So that's what it is about. And securities and commodity transaction tax. We all know that share trading, there is also a concept called commodity trading. You buy gold, crude oil, and all those things. So any taxes, additional taxes levied by concept called security transaction tax, commodity transaction tax, that is STT and CTT. So STT and CTT, that is security transaction tax and commodity transaction tax. Whatever is paid by the assessee is basically considered as a deduction. So you can claim deduction on this section 36. Okay. So that is all about section 36. We'll see a small example for 36 and then proceed further. So X Limited contributes 20% of basic salary. Please remember, it is 20% of basic salary. So what is allowed? What is allowed? 10% of basic salary plus dearness allowance to the account of each employee under pension scheme referred to in section 80 CCD. So it's an eligible pension scheme. Dearness allowance is 40% of basic salary and it forms part of pay to the employees. So now compute the amount of deduction allowable if the basic salary of employees aggregate to 10 lakhs. So now we need to understand how much it is eligible in the hands of employer. So basically, total, what you call basic. Basic is 10 lakhs. So now DA is what? 40%, correct? So 4 lakhs. So 14 lakh is the, what you call, we'll call it as salary for national pension scheme. Okay. Now in this, how much is eligible? So eligible is 10%, correct? 10% of this is eligible. So 1,40,000 is eligible. So 1,40,000 can be claimed as an expenditure under section 36. But what is ineligible, which is disallowed under section 40A9, which is basically balance. So for that we must know actual deduction. So actual deduction is 20% of basic, correct? So of basic, so 2 lakhs. Eligible is how much? 1,40,000, correct? So 40A9 ineligible is 60,000. So 60,000 will be not allowed under section 40A9. 1,40,000 will be allowed under section 36. So that's section 36. Okay. Next is section 37. So that's the last of the section, which is called as admissible deductions. We spoke about a concept called admissible deductions, which is between 30 to 37. Remember section 29? We spoke about the structure in which your business income will be computed. 30 is RRR. We spoke about the movie. So repair and maintenance, rates and taxes, rental and insurance of building. And 31 is what? Plant and machinery and furniture, repair and maintenance and insurance. Then 32 is depreciation. 35 is your scientific research. 35 AD is your 35 AD is your specified business. 35 D is preliminary expenses. 35 DDA is your voluntary retirement scheme. 36 is your other deductions. That is your what we discuss: insurance, provident fund, superannuation, gratuity, your bad debts, bonus commission, security transaction tax, commission tax, national pension scheme. All this was discussed in section 36. Now we are moving to the last section, section 37. So this section is what is basically is called as a general, something like disclaimer, not disclaimer, something like miscellaneous. So which means if something doesn't fall anywhere else, it will come under section 37. So when you say expenditure, it is only expenditure which you have spent not losses or reserves. So what is discussed in section 37 is actual expenditure. What is not discussed here is some losses that you have made or some reserve that you have appropriation that you have made. That is not discussed here. So there are 6 conditions, okay? 6 conditions. So you need to remember the 6 conditions to know whether an expenditure is eligible under section 37 or not. So 6 conditions. The first condition is it is not an expenditure described under section 30 to 36, which means there is no special mention of this section. So for example, we'll take rent paid for hiring plant and machinery. Rent paid for hiring plant and machinery. Is it covered in section 31? Is it covered in section 31? No. Right? Only rent for building is covered in section 30. What is covered in 31 is repair and maintenance and insurance of plant and machinery of furniture. Rent paid for a machinery, if you have rented a machinery, any rent paid to that is not covered under section 31, which means it will come under section 37 because it is not specifically described under section 30 to 36. The second condition, it is not a capital expenditure. I think I need not tell you itself. What is eligible as business expenditure is only revenue expenditure unless specifically provided. For example, 35 AD and 35 provides that 100% specified capital expenditure on specified business or 100% revenue expenditure is straight away allowed expenditure. So typically it must not be capital in nature. So that is the next question. I don't think it is something to be remembered at all. Of course, all the conditions I'm going to tell you right now is something automatic, something inbuilt. You need not even, you need not even remember it. You need not even think it as a law. For an expenditure to be allowed in business, it should not be capital in nature. And of course, we are talking about business. So it cannot be personal. It cannot be personal in nature, correct? So that's the next thing. Then fourth thing is, it must be wholly and exclusively for the associate of business. So it must be for the business exclusively. Whatever expenditure you are doing, it must be exclusively, fully for the purpose of business. There must be no other benefit. So what business? The business carried on by the associate. The business that is already commenced by the associate. The expenditure that is actually incurred. So when you say incurred, it must be due during the year or it must be spent during the year. So this is the provision. So it must be wholly and exclusively for the business that is carried on by the associate, the business that is already commenced, the business for which the expenditure is actually incurred. So these 3 things is what you mean by wholly and exclusively for the associate's business. And the 5th condition is, it must be for the accounting year. That is, expenditure relating to previous year 22-23 only could be covered, not any other expenditure. That's why expenditure like what? This voluntary retirement, preliminary expenses, family planning and all, we are asking to amortize over 5-year period so that we are splitting it. Only 20% is for this year. Only 20% for this year. Balance 80% is for future years. So that is why we are saying that only whatever is due for this accounting year, should be considered. The last rule is called not an offense or prohibited under law. Why is this in green? Rest of the rows are in blue. Only this is in green because there is an amendment to this provision, amendment to this particular condition. So there is an amendment. When you say amendment, not an offense or prohibited under law is not an amendment. The amendment is this. So when you say amendment, it is this. So this is only an amendment. So this explanation 3 is an amendment under the Income Tax Act. What is the amendment? The concept of not an offense or prohibited under law was misused. Not an offense or prohibited under law is basically misused by certain category of people. So income tax felt we need to define what does this word not an offense or prohibited under law means. So the clarification, explanations are basically a clarifications to clarify a particular provision. So now they have clarified this term, not an offense or prohibited under law, by defining it by saying what does that mean. So now what does that mean? It says three concepts. So 1, 2, and 3. It says three concepts, 1, 2, and 3. The first one is it is not an offense, or it is basically it is offense or prohibited under any law. It is an offense or offense under any law or prohibited by any law. When you say any law, it could include any global law, not just your Indian law. Even outside India, if there is a law where it calls this expenditure as an offense, it becomes an offense. So offense or prohibited under the law. For example, bribe, right? Bribe or something, and could be basically prohibited, or it could be an offense under the law, which means anything under the table is not allowed. So offense or prohibited by the law, it includes Indian law and laws outside India also. It's not allowed. Then acceptance of benefit or perquisite, violation of law rule. So which means I am accepting something. Someone is giving me something. I am collecting it. So it is a benefit to me. Or let's say a perquisite to me. But this receipt is generally not allowed under the law. Not just law, under some particular rule, regulation, or guideline. So not just rule or something, even under any regulation, guideline, it is a violation. So it is a violation. So this is what you're actually calling it as. Under law.
Still on it?
I'm sorry, something got activated. Just give me a moment.
Something went wrong. Please try again.
Just give me a moment.
That may be beyond my abilities at the moment.
Okay, I'm sorry. Something got activated and voices started flowing from this voice assistance. It automatically started recognizing my voice and saying that it's not able to help me right now. Okay, anyway, I put it on stop mode for right now. I'm sorry for the disturbance. So this explanation 3, we were talking about the first concept, which is offense or prohibited under the law, which is a global law. So that's the first thing. The second concept that we are talking about is I'm accepting any benefit or perquisite which is not allowed under the law, under any rule, under any guideline, under any regulation. So something or other, it says this is not okay. So that is the next thing. The last one is compounding of offense. What do you mean by compounding? When you say compounding, it is adding, combining. Okay, we'll use the word combining. So compounding means combining. So let's say there are a couple of offenses on me. When you say offense, I've done something wrong. So income tax or any law says you have done 3 mistakes, A, B, C. For A, B, C put together, your penalty or fine is around 25 lakhs. Independently, A independently, B independently, C independently. Now, income tax says, the law says, if you are taking this independently, it is 25 lakhs. But if you are accepting all together, I'll give you a relaxation. I'll allow you to pay only 15 lakhs. You need not pay me 25 lakhs. You pay me 15 lakhs. I'll relieve you from all the 3 at the same time. So I'm compounding. I'm combining A, B, C, 3 mistakes as 1 mistake. And instead of paying 25 lakhs, I'm going to pay 15 lakhs. This is called compounding of an offense. This also, if it is under Indian law or any law outside India, outside law, it is not allowed. So compounding of law also global law. So basically, these 3 is what you are meaning by offense or prohibited by law. So it should be offense or prohibited by any law in India or outside India. It is a benefit or perquisite which is not accepted, which is a violation under a law, rule, guideline, or regulation. Similarly, compounding of an offense under any law. So all these 3 is what you're actually calling by the term offense or prohibited under law. So this term is what is defined under as an amendment under this particular Finance Act as amended to explain you this concept. Okay. So now this concept is what we are doing. We'll see some examples to understand this offense or prohibited under law. Basically, there is a circular which specifically says this expenditure is okay. I'll allow this. So it is basically the first thing is any expenses for religious occasion. So I'm spending, let's say it's Ayudha Puja, puja holidays, I'm spending something for my employees. I'm buying sweets, I'm giving some extra gift or something. So all this, whatever is called as additional thing that is provided on this puja days. So that any puja day or any ritual, any religious, whatever it is, whatever it is given, that expenses is an eligible expenditure. So any occasion, be it Diwali or anything religious nature, it is allowed. And any professional tax paid is specifically allowed. Similarly, any expense to imparting training to apprentices. Apprentices is basically who comes for training, like something like your article assistant. So any expenses that you are incurring for this training to this apprentices, it is allowed. Same way, fees paid to ROC is an eligible expenditure under 36(7). Only thing, it should not be for the enhancement of capital. Why? Enhancement of capital, that is increasing your authorized share capital, is basically your capital expenditure. Increasing your capital is capital expenditure, is not a revenue expenditure. Since it is enhancement of capital, it is a capital expenditure and not revenue, hence not allowed. Any other ROC like annual filing fee or everything is allowed. Similarly, annual listing fee paid to stock exchange. For public issue and other thing, it is preliminary expenses. For subsequently, for every year it is being paid is called as your regular expenditure. Expenditure on advertisement and souvenirs. So any expenditure in the means of advertisement is allowed. Similarly, interest payable on unpaid purchase consideration. What is unpaid purchase consideration? Let's say you have received, you're planning to sell an asset. You have received some money, but you have actually not sold that asset. For that money that you have already collected in advance, you are paying some interest. So that interest is an eligible. And payment to eligible on profit sharing scheme, rebate passed on by the consumer cooperative stores. So these are general expenditure which are specifically allowed under section 37. We will see some other expenditures on the right hand side. What is specifically allowed, what is not allowed. Advertisement and souvenir, we said it's specifically allowed through that circular. But if it is to a political party, if the advertisement and souvenir is to a political party, it is not allowed. It is not allowed. So advertisement and souvenir is allowed, but advertisement and souvenir to political parties alone is not allowed. And any CSR expenditure. What is CSR? Corporate social responsibility. So some companies who have met certain conditions are eligible to apportion some of their profit for corporate social responsibility. It is kind of application of income, like an apportion. It is not an actual expenditure. So it's a kind of application of income and hence not treated as an expenditure. So it's not allowed. Freebies to medical practitioner. So we saw not an offense or prohibited under law. Medical guideline says that doctors are not supposed to receive any freebies. So if they receive any freebies, whatever freebies has been provided, that company cannot claim it as an expenditure because freebies provided to the medical practitioner is against the law, is an offense or law. As we saw in the earlier law, it is against the guideline or rule prescribed by the medical practitioner. So that's what it is. Premium on key man insurance policy. We said receipt from key man insurance policy is a taxable income under charging section 28. Similarly, any premium paid to that is a business income. So it is allowed. Expenditure incurred on abandoned feature films. Basically, let's say I am a producer. I have invested let's say I've invested 2 crores in creating a film, but due to various issues, the film could not be released. We would have heard the story plenty of times in movie industry. So I have spent 2 crores. I'm not able to release my movie. I have waited for 3 years. Now, after 3 years, I have decided to abandon this, that I'm not at all going to release it. So now I'm going to write off this total cost. This write-off is not a capital receipt. It is considered to be a revenue receipt. So it is specifically considered as a revenue receipt. So expenditure incurred on abandoned feature films is considered to be a revenue expenditure. So which means it is an allowed expenditure under section 37. So these are specifically discussed in various circulars, various judicial rulings and various part of the circulars. So this is what is specifically allowed, what is specifically not allowed under section 37. Correct? So with that, we have covered the entire section of 30 to 37. We will try to talk about the next sections. Okay. So basically, yeah. So I'll just see if there are any questions on 36, 37. Okay. Doshi pro rata means apportion. If it is for 5 years, you split it for 5 years. Abdul, transaction tax paid to foreign currency. Please remember what is allowed is only two types of transaction tax: security transaction tax and commodity transaction tax. It could be Indian, it could be foreign, but the concept is security and commodity. If we actually know that is not levied on foreign securities, what is levied security transaction tax and commodity transaction tax is only which is routed through Indian stock exchanges. So if it's a currency purchased through Indian stock exchanges, if there is any transaction tax as security or commodity, it is allowed. I don't think it is actually there. In case if it is there, please go through the concept of whether it is security transactions or commodity transaction tax. If it is one of these, it is allowed. Rushikesh, please explain again accounting year. Okay, probably we'll keep it this way. Accounting year is the financial, right? April to March. So it is basically previous year according to income tax terms. So this previous year is between 1st April and 31st March. For your exam, it is 2022 and 2023. It's a very confusing chapter. Of course, yeah. And of course, you'll know a lot more sections in business and a lot more detail based on judicial rulings also in business. My suggestion would be try to understand the concept in general. Just imagine yourself doing a business. What are all the expenditure you think it is okay for a business, not okay for a business? Just compare it with your understanding under section 36. We spoke about bad debt. It is okay because you are not able to collect it. It must be considered as an expense. We spoke about insurance. So if you actually look at each of this section, it is very general. It is very specific. But for this scientific research, specified business, I think every other section is very general. It's nothing legal about it. If you actually think it at a very rational level, what is allowed, what is not allowed, you will get the same thing what has been drafted as the law. So I think leave out the sections and other things. Just imagine yourself doing a business. Just think what expenditure is allowed. List out the expenditure that you will incur for business. See what will be allowed, what will not be allowed. And just compare it with the section. You will get the same answer. You will not get a different answer. So just imagine yourself doing a business is what I would say. Kavita, what is profit sharing scheme? Sometimes you distribute profit to employees through equity shares and other things. That is what is called as profit sharing scheme. Abdul, interest paid on loan, which is for buying. Yeah, if it is for an asset, if it's an asset, till it is put to use, it is not allowed. Anish, any restriction? No. Similar to bad debt, you need not prove. Just that the film should not be released. That's all. What is the meaning of advertising in souvenir? Souvenir is like merchandise. Let's take a diary, a notebook, or a keychain, or a pen. If it is being distributed and you print your company's name on that, on the pen, on the diary. So that is called advertisement in souvenirs. So anything which is given like a merchandise, imagine you would be buying your favorite IPL t-shirts and all, right? So that printing is something like your souvenir. Okay, with that, okay, we'll move on to the next thing. So we have covered all the allowances. Whatever we have discussed from section 30 to 37 is allowances, that is eligible to be claimed as an expenditure. Now we are going to move into the topic which is going to be discussed as disallowances. What is not allowed? What is not allowed? So what is not allowed? The first section that we are going to talk about is 40 clause A. So section 40 clause A. In that clause A, the first two things we are going to discuss about is for TDS. Okay. When is this provision applies? When a TDS is not deducted. What is TDS? Tax deducted at source. You will discuss or study this in detail in that respective chapter for advanced tax and tax deducted at source. So basically, TDS is not deducted. TDS is not deducted. or it is deducted, but it is not paid. It is not paid on or before the due date of filing return of income, not on the respective due date on the filing return of income. So that is what you mean by not deducted or not paid. So that's what it is. What are the expenses? The first expenses talks about interest, royalty, fees for technical services, and any other sum. But for 1A, it is any expense which is on which tax is deductible. So I'm not going to explain you much about what section TDS applies and all, because it's a separate chapter. I will not even answer the query if there is something on that question. So tax deduction is basically when you pay someone, you deduct a tax, you pay it to the government on behalf of them. So on this expense, if you are not deducting or not paying, that expenditure is disallowed. A proportion of that expenditure is disallowed. And the first clause, that is interest, royalty, fees for technical services, it specifically, if it is paid to outside India or paid to a non-resident. So typically, if you are paying to outside India or paying to a non-resident, so we'll remember we are paying to a non-resident. So forget that. So we are paying to a non-resident. So if you are paying to a non-resident and that payment is relating to interest, royalty, fees for technical services or any other sum, then this provision will be applicable. When will this provision be applicable? If the TDS is not been deducted or it is deducted and not paid to the government. On this situation, 100% of such expenditure will be disallowed. Will be disallowed now, but if subsequently in the next year, if you have actually deducted and paid, you can again claim it as allowed. We'll take an example. We'll take an example of this. So typically it's like, we'll take this example like, let's take rent. Okay, we'll take rent as an example. Rent is supposed to be paid monthly 50,000. Okay, this is value. TDS on this is 5,000. And net paid to the owner. So the owner will be actually receiving 45,000. This 5,000 will be remitted to government. Okay. And this remitted to government will come to the owner as credit. Tax credit. Okay. We will be getting it as a tax credit. Now, we say disallowance happens when this amount is not deducted or not paid. Okay. So if you have not deducted or not paid, we say there is a disallowance. Now, let's say this transaction is on March 2023. I have not deducted, I have not paid during that entire till my return is filed. So I will disallow this. Okay. I will disallow in previous year 2022-23. Okay, 2022-23. But let's say on June 23, I have deducted, not June, we'll keep it as December 23. I have deducted and paid this 5,000. Which means now I did not follow something, I did not comply with some rule, so there was a disallowance. Now I have complied. Now I have complied for the same transaction. First I did not comply, so it was disallowed. Now I have complied. Which means it must be allowed. So that's what they're saying. Subsequently, I have followed the rule. So this will be allowed. This will be allowed in previous year 2023-24. Okay, what will be allowed? We'll just see that now. So the concept is it will be disallowed. Subsequently, it will be allowed in the year of thing. So if it is an international payment, that is to a non-resident or outside India, it is 100%. If it is domestic, it is 30%. If it is domestic, 30%. So let's say this is a domestic payment. Let's say this is domestic rent. Okay, domestic rent. So which means what will be disallowed here will be 50,000 into 30%. That is 15,000 will be disallowed. And again, what will be allowed will be this 15,000. So this 15,000, what was disallowed earlier, will now be allowed. So this is the concept. So if it is an international payment to a non-resident, it is 100% of the expenditure. If it is domestic payment, it is 30% of the expenditure. So that's what. So what should you remember? You should remember, if tax is not followed, if TDS is not followed, if tax deduction is not deducted or not paid, if it is an international payment, if it is an international payment to a non-resident, 100% of that expenditure is disallowed. But if it is a resident for domestic payment, 30%. The only thing is, subsequently, when it is deducted and paid to the government, that expenditure, what was already disallowed, will now be allowed. So this is the concept. This is the concept of TDS under section 40 clause A relating to TDS disallowances. So this is what it is about. There is a couple of examples on this illustration. Of course, we do not know whether we do not know about the tax TDS provisions as of now. So I'll just tell you whether it is taxable or not. So typically what is happening is, salary to employees is credited and paid in March 2023. So which means it's they are saying for these two expenses, it is being paid without deduction of tax at source. So what happens is 12 lakhs, whatever we have actually paid as salary, on which tax has not been deducted and paid. So that is what is there. So for March 23, it should be disallowed in financial year 22-23. It should be disallowed in 22-23. So for this 12 lakhs, it will be disallowed. Similarly, for director also, it is credited in March 23. What is relevant is the date in which it is credited, not the date in which paid. For some section, the relevant date is paid. But for these two, what is discussed here, the relevant date is credited. So it is credited in March 2023. So both these expenses, that is 12,28,000, is an expenditure on which TDS has not been deducted. These are what deduction? International, domestic. These are domestic, right? Salary and direct remuneration is domestic. So 30% into 12,28,000 will be disallowed in financial year 2022-23, assessment year 23-24, but subsequently allowed if it is actually be paid in later point in time. So that is about here. Next is, during the financial year 22-23, the following is given. It speaks about a person called Raja. His turnover in March 22 was 19 lakhs. Why is this important? Because in some of the TDS condition, you need not deduct TDS if your turnover is less than 1 crore. Okay. So the interest is first 45,000. Interest is 45,000. Whether TDS is applicable or not, moment your interest is more than 5,000, TDS must be deducted. So which means it is a non-compliance. So 30% of 45,000 should be disallowed. Okay. Next thing is, paid to a resident, was paid as salary to a resident without deduction of tax at source. So for this also, for salary, for everyone it is applicable, TDS must be deducted. If not, 30% of that will be deducted. Commission of 16,000. Commission provision is applicable only for people whose turnover is more than 1 crore in the previous year. So which means their turnover is less than 1 crore. So TDS is not applicable. So this is basically allowed. You need not disallow anything for this. So out of these three, the first interest, it is applicable for everyone. Your interest on securities, I'm sorry. So for this also, it is typically interest is only for person who are subject to audit. So for both interest and commission, the provision is applicable only for person who have crossed 1 crore limit. Since his income is only 99 lakhs, TDS provision itself is not applicable. I'm sorry. So even if tax has not been deducted, for both these section, interest and commission, it is allowed. But for salary, it is applicable even if you are not crossed 1 crore. So there alone, this expenditure alone. So out of 10 lakhs, how much is disallowed? Out of 10 lakhs, 3 lakhs will be disallowed. Okay. So that's about your thing. Okay. So I'll just answer any question, something. Okay. So basically, other 48, other than other sections in 40 clause A, give me a second. I'm sorry. So other things other than TDS, other things in 40 clause A is any rate or tax levied is not an allowed expenditure. So any taxes is not an allowed expenditure. Similarly, any royalty license paid to a state government. So certain expenditure paid to state government is not allowed. Then any so it's basically paid by a state government. So state government paying royalty license fee is not allowed. Salary payable outside India, non-resident, on which tax has not been deducted is not allowed. So this is also relating to TDS. And effective made from, so basically any deduction, PF, other than PF, what was discussed earlier, whatever is that fund for employee, which needs to be paid to government, is not paid, will be disallowed. So similarly, these things will not be deductible on certain circumstances. So if you take any rate or tax, it is not allowed. Any royalty by state government, not allowed. Salary to non-resident on which tax is not deducted, not allowed. And any fund on which tax needs to be paid, not allowed. Any tax paid on non-monetary perquisites. What are non-monetary perquisites? Your housing accommodation, your motor car, all these are called perquisites, non-monetary perquisites. So whatever is tax liable on that should be deducted and paid to the government. If not, that whatever tax is paid on that non-monetary perquisite is not an expense, to that employer. So that is tax on non-monetary perquisites. To summarize, we'll start with first thing, any rate or tax. When you say tax, there is an amendment in this year. Tax includes surcharge and cess. So not just tax. When you say tax, it includes surcharge and cess. Earlier, there was a confusion whether tax refers only to income tax or income tax, surcharge and cess. Now it has been clarified saying that tax always means surcharge and cess also, not just tax. So that's the first thing. And this I've said, salary to non-resident affairs. So these are the expenditure which are basically disallowed under section your 40 clause A. So this is what it is about. So the next thing, we will cover 40 section alone and complete this session, probably another 10 minutes if I'm okay. So this is what is 40. So apart from this section 40, as far as your questions are concerned about this particular provisions, what we discussed right now, it is linked to your TDS section. So when any problem, it will be linked with your TDS and your this section. So it is a linked section. You will understand this completely only when you are completing the TDS provisions. So I'll just cover one section alone. There is only one more section which is on 40B. Yeah, there is only one more section. I think I'll cover that alone and stop it. So we'll stop with 40. With this slide, it is done. So just give me to allow. I know there is too much of load today on what has been discussed. So we'll cover only this slide and we'll stop it. So basically, this is 40 clause B. What does this say? It says certain payments to partner are not allowed. So basically, any remuneration is not allowed. It's not allowed if it is paid to a person who's not a working partner. So only to working partners. So the agreement or the partner should be a working partner to claim remuneration. It's a very basic thing. Only if I am contributing to my firm, I'm eligible for remuneration. If I'm sitting dormant, I'm not eligible. So remuneration is not allowed for any partner. And similarly, no expenditure on interest or remuneration will be allowed if it is not provided in the partnership deed. Partnership deed should say you are eligible for interest, you are eligible for remuneration. Otherwise, it is not allowed. And when you say interest, it includes interest to paid in partners in representative capacity. So, which is basically, let's say I'm a partner. Now, my spouse has lent a loan to the firm. Now, whatever loan provided to my spouse, if it is because I'm a partner, then that interest is also restricted. Otherwise, it is not restricted. So basically, if I'm a partner, if I have lent money, me or someone known to me has lent money in my capacity, then that should also be considered for this restriction. Otherwise, it's not. So just remember this. Don't confuse this concept, confuse much. So just stop it as interest and remuneration to the partner is allowed. Just understand what the concept of representative capacity means. Don't go beyond that. So how much is allowed? So we are going to talk about how much is allowed. If it is an interest, 12% per annum. One of you actually questioned me in the last class or previous class about an example one in your illustration in that page 182 of study material or something, if I'm right. So that example is about how much interest is allowed. The maximum interest is 12%. Now, if you go to page 182 and go to example 1, you will understand that. So the maximum interest a partner can take is 12% of capital. It cannot be beyond that. So the maximum interest is 12%. So anything beyond 12% will be disallowed under 40 clause B. So that is interest. As far as remuneration, it is like a slab rate, like your individuals and other thing. It's a slab rate. The slab rate is for first 3 lakhs of book profit, which means even loss can claim remuneration. Even if you make a loss, you can claim remuneration. First 3 lakhs of book profit, 1.5 lakhs or 90% of book profit. 90% of book profit, whichever is more. So, which means a loss-making entity can still claim 1.5 lakhs. Correct? Because loss-making entity, the 90% will be a negative number. So 1.5 lakhs. For the balance book profit, that is above 3 lakhs, it is 60%. So let's say your book profit is 3 lakhs, which means 1.5 or 90%, which is 2.7 lakhs. 2.7 lakhs, whichever is higher. So which means you are eligible for 2.7 lakhs. Anything above 3 lakhs, it is flat 60%. So anything above 3 lakhs, it's flat 60%. So this is the remuneration allowed. How much ever you receive, what is actually allowed in the hands of the firm and the partner is only this much. So only 90% of the first 3 lakhs or 1.5 lakhs, whichever is more. And from the balance, 60% of the book profit. So what is book profit? Whatever is actually computed according to the accounts, whatever is actually computed in according to the accounts, in that you remove remuneration alone. What already provided remuneration should be removed, then calculate and allow whatever is there. We'll take a small example. Okay, let's say the profit is 10 lakhs in P&L. This is in P&L, and it is remuneration is let's take 4 lakhs. This is per P&L, which means it's already provided. So this 10 lakh is including P&L. So this is includes. Correct? So what I do is I first profit 10 lakhs, add remuneration already debited. If it is already debited, I need to add that 4 lakhs. So 14 lakhs. In that 14, I need to split into 3 and 11. In this 3, 90%, that is 2.7. In this 11, it is 60%, that is 6.6. So total is 9.3, correct? So I am eligible up to 9.3, eligible up to 9.3. So since what I have given is only 4 lakhs, I can claim the entire 4 lakh. Remuneration is 4 lakhs. So I will be eligible for 10 lakhs of profit. This is my taxable profit. Because I'm eligible 9.3 up to 9.3. Don't give 9.3 up to 9.3. But what is given itself is 4 lakhs only. So I'm giving it. If in the same example, if we consider this as, I'll just write the numbers here. Let's say the profit is 1 lakh. Profit is 1 lakh. Remuneration is 4 lakhs. So which means 1 lakh, add 4 lakhs. So I will get how much? 5 lakhs. So in 5 lakhs, I split it into 3 and 2. On 3, I am eligible for 2.7. On 2 lakhs, I am eligible for 1.2. How much I am eligible? Totally 3.9. Correct? 3.9. So which means I am eligible only up to 3,90,000, not 4 lakhs. So what I will less is 3.9 lakhs. So which means my profit will be 1.1 lakhs. Clear? So what is eligible alone should be provided. Eligible or whatever you have received, whichever is lower. So that's what the concept is. So with that, I think we will close for the day. We will cover the next section will be 40A. We will cover it in the next session. I'll just answer few questions alone is there. Okay. So typically, whatever we have discussed now, I'll just give a brief discussion and close it. So we spoke about section 35D, that is preliminary expenses. You claim preliminary expenses for 5 years, that is 20% per year. What is eligible expenditure we discussed? We said eligible expenditure is restricted to 5% of capital employed or cost of capital employed. So that is there. And the next thing we discussed about 35DDA, where we said voluntary retirement. Whatever is voluntary retirement, 20% is allowed. Then we discussed 36. We discussed about insurance, provident fund, employer contribution, employee contribution, bad debts. What do you do when there is a subsequent shortfall in bad debt? Excess in bad debt we discussed. Then we discussed about other 36 provisions, which was like bonus, commission, security transaction tax, security transaction tax, your commodity transaction tax, and all those things we discussed. 37.6 condition that it must be not personal in nature, not capital in nature. It must be incurred in the accounting year. It must not be covered in section 30 to 36, and it must not be an offense or prohibited by law. We saw that there is an amendment for the concept of offense or prohibited law. 3 explanation. First, offense are not prohibited under any global law. Second is, it must not be a violation under any law, rule, or regulation or guideline. Any benefit or perquisite received should not be a violation. The third one is, it must not be a compounding on offense. This is what we discussed on section 37. Then we discussed about 40, clause A. First thing we discussed was TDS. If it is not deducted or not paid within the due date of filing return of income. If it is international, 100% of expenditure is disallowed. If it is if it is domestic, it is 30% of the expenditure is disallowed. Other 40 is any rates, taxes, any tax on monetary, non-monetary perquisites, and any salary payments to non-residents on which tax has not been deducted. All these expenditure is not an allowed expenditure. That is 40 clause A. What does 40 clause B? Interest and remuneration to partner. Interest is allowed up to 12%. Remuneration for first 3 lakh of book profit, 90% or 1.5 lakhs, whichever is more. For the balance, 60% of book profit. What is book profit? Whatever is the profit computed before providing remuneration. That's why we add remuneration and then calculate book profit. So book profit is basically your whatever profit as per the books of accounts, which is taxable. You need to add remuneration and then calculate 90%, 60%, and then that's why we must first add and then deduct. So please remember, it's like depreciation. First, you add book depreciation and then you reduce income tax depreciation. Similarly, you need to add remuneration and then reduce remuneration. When you add remuneration, you need to calculate remuneration on the available profits after adjusting remuneration. So that's what it is about. So the concept is similar to depreciation. Add first and then compute and deduct. So that's what it is about. So with that, we will wind up for the day. So thank you for the wonderful session. We have 2 more sessions to cover PGBP alone. So we will continue with whatever we left out in this session and take it forward from the next session. So with that, we will wind up for the day. And thank you for the wonderful session. I'll close it with this. Thank you.